Hi, everyone, and welcome to this episode of the Represented series. Thanks for tuning in. We've really got some amazing information that we're going to share for you today. Our special guest is Jorge Soriano. He is a partner advisor at AdvicePeriod and has been advising clients for over 10 years, primarily focusing on comprehensive wealth management for individuals and families. Day-to-day, Jorge manages all client requests for the team and is an integral in design and implementation of all investment and planning recommendations. Before joining AdvicePeriod, Jorge worked at the asset management firm Dimensional Fund Advisors as part of their financial services group in Santa Monica. Prior to Dimensional, Jorge helped manage a fee-based financial planning firm that specializes in working with high net worth and mass affluent families. Jorge earned his MBA from Duke University Fuqua School of Business, where he was awarded the Distinguished Services Award by his graduating class for contributions to the business school. He received his BA in economics with honors at the University of Southern California. He is a veteran of the United States Marine Corps, where he served for 6 years, attaining the rank of sergeant and receiving numerous awards, including the Navy and Marine Corps Achievement Medal and Combat Action Award. He is an avid sports fan and is passionate about leadership and mentorship. Outside of the office, you can find Jorge spending time with his Frenchie and traveling all over the world. So I'm going to bring Jorge in, and we're excited to have him. Jorge, welcome.
Thank you for having me. Excited to be here.
Absolutely. And I love the part about your Frenchie because I have one as well. And I know they hold a very special place in our hearts. Right?
It's been a fun experience, especially during this time, to have a companion like a Frenchie. They're wonderful companions. So yes, it's been interesting in time. Now she's a little too used to me. So we're going to have to figure that out once I'm actually back in the office on a regular basis.
I know it's going to be hard to kind of disconnect that, right?
Exactly.
Well, it's great to have you, and we're really excited about what you're going to present and talk to us about today, which is the do's and don'ts of portfolio and asset management allocation.
Sure.
So we're looking forward to that. But before we get started, I just want to jump in and really just ask you, especially, where we are with COVID and everything that's going on in the world, what it really means for you to be a financial professional of color during this time and just in general.
Yes. While I've obviously been kept fairly busy during this time working with all of our clients that we work with as a team, I've really tried to make the effort to do things that I've not done in the past, which is really reach out to, let's just say, underserved communities that could benefit quite a bit from just financial literacy, to just understanding how they can then create their own mechanisms for creating their wealth, right? So it's one thing to earn a living and do well there. It's another thing to actually have the proper building blocks to create wealth. So I've spent quite a bit of time, mostly on my own free time, trying to help others that aren't a part of our client base, particularly in communities of color. So that, because that's near and dear in my heart, it's obviously based on what my experiences were growing up and my relationship with money, that I felt it was important to do that, especially in a time that is we're dealing with obviously health and financial stresses in our lives. So that's really been how I've been trying to focus my time in this particular year.
Yeah, that's fantastic. And you hit the nail on the head. We're definitely in a place of financial stress. So our goal with having you today is to be able to ease that stress off everyone watching and that will, continue to watch this. So I am going to turn it over to you and allow you to take it over. So Thanks again, and I'll be back.
Bear with me as I share my screen here. Okay, so hopefully everybody can see that. What I want to do is hopefully provide those of you who have obviously a broad audience of various investment backgrounds. Either you may be a beginner, terrified about this environment. You may be a little bit more advanced in your investment experience, but also terrified potentially. I want to just lay the groundwork for what we'll talk about in the next half hour or so, 45 minutes. I'm happy to answer questions throughout. But I wanted to be very clear about what we'll cover and then also what we won't cover. So first and foremost, let's just get 2020 in perspective. I have some data points that I think may be of surprise to some of you, others may not, as it relates to what's been happening in the stock market. And so we'll talk about that just to lay the groundwork and create some context around the discussion. And then I want to get into those key investment principles that I think are important for all of us to learn more about, understand. And what that really gets into is having an investment philosophy, and one in particular that you can stick with regardless of what is happening in the market, in the economy, in your own lives, because I think that's really critical to having investment success. So we'll get into some of those concepts, and then we'll get into the portfolio building blocks. What does this actually look like to build an asset allocation, to build a portfolio? What do we even mean by all of that? So this will be particularly important to those who have retirement plans at work, 401k. When you're looking at all the various options, how do you even put that together? For anyone that's investing outside of their 401k and their brokerage accounts or other retirement accounts, we can certainly address those as well, because those are obviously tied together when you're thinking about your overall portfolio. While the focus of this conversation will be investing in the stock market or in the bond market, which are publicly available and traded on a daily basis, this doesn't neglect the fact that your entire portfolio is often made up of more than just that, right? Whether it's cash that you have, other assets such as real estate or other illiquid assets, private investments. If you're running your own company, that's certainly a part of the overall portfolio. But for this particular conversation, we'll focus on creating that portfolio as it relates to stocks and bonds. And then again, going back to where you are in this phase of investing in your own life, how you can get started, some tips there. And obviously, if you've already been doing it for some time, how you can potentially refine that as well. And I'll end with some resources for you, books that I've read, blogs. I've written a couple of articles that I'm happy to share. So those will come at the end. In my display name, you see my name as well as my email address. That's for anyone who wants to send me an email after the fact. I'm happy to have one-off conversations. Obviously, no obligations whatsoever other than leaning on me as a resource for any of the questions that you may have. And I'm happy to point you in the right direction or answer your questions after the fact. We will be taking questions throughout, so feel free to send your questions. Dana will help facilitate some of that. So let's get right into it. Before we move on to the actual presentation, I want to be clear about what we won't cover. So key to the investment principles part of this, we're not going to have any conversation about what's the hot stock, how to pick winning stocks, how to time the market, how to take advantage of trades in your Robinhood account, for example, which I'm happy to address why that's not something that maybe makes a whole lot of sense for your long-term wealth building plan, even short-term. So I just want to be very clear that what we're talking about here is obviously based on my decade-plus experience advising clients on asset allocation and investments, but also much of it is rooted in academic research and what I would like to call the science of investing. So this is far from opinion or letting you know how I've managed my own portfolio, which I'm happy to share, but it's really about having sound investment principles that you can lean on when it comes to your asset allocation that you build for yourself, regardless of how and when you're going to do it. The key is to get started, do something now, and then refine it as you go. So let's get right into it. So what's been happening in 2020? Wow, this has been a whirlwind of a year. Couple stats just to lay the groundwork. The market high, depending whether you're looking at daily returns or intraday, essentially February 20th is when we saw the last high. So that was the peak of the market. And then we saw the precipitous decline all the way down to what has so far been the bottom of March 24th. So that is a very rapid decline. In fact, the fastest bear market of 30% or more that we've ever seen. So this is historic, right? In any way that you want to measure this, how quickly the decline happened, how big of a decline, and some of the daily returns that we were seeing, pretty historic. To, I guess, counter that with what happened in 2019, there were 0 days that had declines of more than 3%, right? So what does that mean? That we've had pretty good low volatility over the last several years, and particularly 2019. Now, if you look at the time period that I just referenced, there were 11 days. So none in 2019, 11 in this 1 month time period alone in excess of 3% decline. I mean, that is meaningful. And why I compare that to 2019 is that we as investors, if we had been investing, have had just a nice ride for quite some time post 2008 global financial crisis of just market increases over that time with not that much volatility, save for a few instances. So we've sort of been lulled, if you will, to sleep leading into 2020. So when this happened, it really affected us, I think, significantly in ways that we hadn't expected, because we forgot that investing in the market comes with volatility, right? Keep in mind, though, when you look at those days that have been down more than 3%, there were also 8 days that had returns in excess of 3%, so up 3%, right? So that's a key important thing to remember, is volatility works both ways. And oftentimes these up days and down days are actually clumped together. So going back to this idea of trying to time the market and get in and get out, you're often going to actually miss the best days, all for trying to make sure you're not declining or having your portfolio decline on those worst days. So this is where it gets really tricky to try to time the market, because those days are oftentimes clumped together. And in fact, when you look at the entire stock market history, and again, when I'm talking about the market, I'm just referring to the S&P 500. It's a broadly referenced index of the 500 largest companies in the US. So that's really what I'm referring to when I'm talking about the market and these metrics, and they're a good measure for a lot that's been going on, again, based on the companies that are represented in that index. But 5 of the best stock market days in history actually happened during that time period, in particular in March 2020. So that's significant when you talk about 20,000 or so or more trading days in stock market history, almost 100 years. We've seen some historical numbers here over this short period of time. So what does this all mean, right? That's the stuff we want to make sense of, so that you can figure out how it translates to asset allocation. And year to date, looking at today's close, markets are up for the year slightly, but when you think about the significant decline and then the significant return from March 24th, the market is almost up 45 to 46% just from March 24th alone. I mean, that is just astounding numbers. It's incredible to see what that rebound has looked like. So if you've done nothing in your accounts for this time period, and you were broadly diversified and had all the market exposure that you needed in your asset allocation, you basically were unfazed, which is pretty fascinating. So what else is going on? We're obviously in the middle of a pandemic, which has brought on the recession that we're smack in the middle of in. Right now, we don't know what that's going to look like in terms of a recovery. Obviously, when it comes to issues of police brutality and the protests that have been going on across the country and really across the globe, right? And of course, let's not forget we're in an election year. So there's a lot going on in 2020. And I think for many investors, this can really scare them into either no action or the wrong action. So those are the things that we want to educate and dispel to make sure that you're doing the right things in your asset allocation. And that's why I think the portfolio building blocks are key to that. I'll pause for a second. I'm not sure if Dana will have questions that are coming in. I'm happy to answer them throughout. So if no questions are coming in, I'm happy to go on to the next and get into the portfolio building blocks. So the first thing that we want to think about is, well, what's the approach or the philosophy that I should take? So there's 2 things that I want to bring together here. One is an investment philosophy that will help you and guide you through these environments, number 1. And number 2, looking at areas that are well within your control when markets are not, right? So that's a key thing there. Markets are not in your control. We can't control the daily returns of the market or what's going to happen in the economy, but there are things in your asset allocation that are well within your control. So let's get into those. First and foremost, for all the criticisms that you may have, and I have them myself, about capitalism and how capital markets work, there has to be on some level, an underlying belief and understanding that capitalism does work. That for a given level of risk that you're taking on, you should expect as an investor a certain level of return, right? Risk and return are connected, and investing in companies and investing in stocks is essentially with the expectation that you get to benefit from the future cash flows and profits of those companies, right? There just has to be that fundamental belief that you're in a system that allows you to benefit and profit that way. That's what mechanism for creating wealth that many of us here are looking to build for ourselves and for our families. So that's number 1. Number 2, which is often debated, is this belief that markets work. So there's a level of efficiency that is created in the stock market, which is essentially a supply and demand market. For every buyer, there's a seller. Regardless of where the prices are in the stock market, There's always going to be a buyer for a seller. Now, obviously, if there are more buyers than sellers, markets are going to go up. If there are more sellers than buyers, markets are going to go down. That's the daily movement of this supply and demand market. But there's a lot of information that's being processed with those trades. Just to provide some context, on a daily basis globally, there are millions of trades that are being executed and hundreds of billions of worth of stock and bonds that are being traded on a daily basis. So there's a high level of efficiency that's being presented there for investors. So the idea is to understand that that efficiency and the information that's being processed by buyers and sellers is something that we can just accept as a given rather than trying to second guess the market or think that there are mispricings and try to act on that information. So that's going to be a key thing that I would highly recommend you think about when you're thinking about markets and market efficiency. And then getting into this idea of market efficiency, well, if markets work and we've seen historical returns of the market, well, then why try to find the mispricings or forecast what's going to do well or what's not going to do well? Just own it all, right? So that's where diversification comes in. And while in the market, there's a given level of return that's expected for a given level of risk that you take on or expose yourselves to, diversification is one of those areas that I would consider one of the few free lunches, if you will, when it comes to investing, meaning you can get the exposure of the market in aggregate, participate in those returns, and actually reduce your risk on some level. When I'm talking about risk, I mean volatility, because you're buying and owning everything. And what does everything mean, right? So we're talking about three major components of diversification. There's U.S. Stock market exposure. There's international developed countries, 20 or so plus countries. And then we're talking about emerging markets. So all told, that represents 40 plus countries, about 10 to 12,000 stocks globally that you can participate in. And the idea is to own all of that so that you participate in aggregate when markets go up, but you also don't suffer as much when individual or a handful of stocks go down. And this has been really interesting during this time because while people have been touting a handful of stocks that have done well, investors who are highly diversified are also participating in that and doing really well, and also didn't suffer as much when markets were going down. So while everybody was seeing the S&P have a 30% or so decline, and we were getting calls from clients, obviously, that were concerned, when you looked at their portfolio that had a broad diversification and also had bonds incorporated into their allocation, many of them weren't even getting anywhere near that 30% or so decline. Some of them were getting less than half of that of a decline, if that, because their stock exposure was not what they even expected. So this gets into some of the fears when you're following markets, maybe a little too much, a little too closely. Financial media is notorious for either stoking our fears or our greed. So you want to be careful about the things that you're being exposed to. And this is where these key principles are really crucial to helping you have successful investment outcomes. So let's get into a few more areas that get into areas within our control. There's a lot of evidence to suggest that fees are really important to have positive investment outcomes. And what that means is the higher the fees that you incur, whether it's through transaction costs or buying funds or mutual funds that are very expensive, the average equity mutual fund is anywhere from 0.8 to 1%. Those are going to really impact your returns over time. So compounding returns that you want to participate in your portfolio are also going to be negatively impacting your portfolio if you have this 1% or so of average fund fee eating away at your portfolio. So fees really matter. So the idea is to reduce your costs as much as possible. And if we're talking about diversification, you can capture this through low-cost index funds, for example. So Vanguard is obviously well known for being a provider of low-cost mutual funds and ETFs, exchange-traded funds. So very comparable. So that is one area that you can immediately get within your control by buying into low-cost, broadly diversified index funds, for example. And then tax efficiency. So I like to think about tax efficiency as how much you're actually buying and selling your portfolio. So the turnover, beyond adding to your portfolio, if you're in a 401k and putting money in there periodically, beyond just normal rebalancing, right? Adjusting the portfolio to the mix that you've predetermined, there really shouldn't be much more that you should be doing in your accounts. Trying to actively buy and sell, pick winners, or do all of this maneuvering in your portfolio, all that just means is poor investment outcomes because your after-tax returns are going to be much lower because you're trading too much. So trading a lot, is going to incur taxes, which lowers your overall net return or your after-tax return. Again, we're talking about if you're investing or trading in accounts outside of a retirement account. And so I like to think of money or these portfolios as a bar of soap, right? The more of it you handle, the less of it you have. So you want to be very careful about inserting yourself too much. And there's a lot of ways that you can account for that. You can automate these things, right? Where you don't touch it, sort of set it and forget it. There's a number of platforms that are referred to as robo platforms that allow you to just put it, and the asset allocation is done for you automatically at a very reasonable cost. So those are the types of things that are well within your control, where you get to participate in markets. And again, set yourself up for good investment outcomes down the road. And the last and important concept here within your control is asset allocation, right? This is going to be key. This is fundamental to successful investment outcomes. What is the exposure that you're creating within your portfolio, right? How diversified are you? Are you across regions? The mix of stocks and bonds, all of these things are going to be really critical to good, successful investment outcomes. So that, again, is really a component of investment principles that can help outline an investment philosophy that you can stick with, right? Obviously, implore you to do your own research and education and educate yourself on this, but also understand that there are areas within your control that can allow you to have a successful investment experience, even if the market is moving around on a daily basis. And it's going to do that, right? On a given day, the market's going to be up or down, and it's really a 50-50 chance of that happening. So there's really no sense in trying to get caught up in the day-to-day. So I'll pause there, see if there are any questions related to investment principles or some of these philosophical beliefs or thoughts that we have. And again, these are things that we employ for clients. Even some of the most sophisticated, some of the wealthiest clients also just employ these concepts because it just makes sense, right? It just makes sense to incorporate this to have those successful investment outcomes. If no questions, I'll move on here. So I think this is important to provide some context for investors, however experienced or not they may be, is the evolution of investing. So I like to think of this as a little bit of a timeline. So let's just say pre-1950, the belief was that active investing was really the only way to have success in investing in the stock market, right? So you would have to be diligent, do your research, find the best stocks, read company financials if you had access to that, also forecast what you think was going to do well, and find mispricings within that, right? Look to see where the winners are or where those winners are going to be. The problem with that is that tends to generate quite a bit of turnover, can be more costly, and there's risks there. If you have these convictions around particular areas of the market, you now are not as diversified, and that has the potential to expose you to unnecessary risk. So that was the conventional wisdom going back pre-1950. Clearly, a lot of investors and money managers still employ these strategies, but around the 1970s or so, and this was after this idea of asset allocation was first published in 1952, or what we know as modern portfolio theory, where really the risk associated with your portfolio and the investment outcomes associated with that were really tied to your broad mix of stocks versus bonds and not much else. Most of your return is going to be determined by that. There were a lot of individuals who were looking to do something different than trying to just pick winners or losers. They were looking to see what broad exposure could be applied with that modern portfolio theory concept in mind. And so that's where you started to see index investing come into the fold, or what's called passive investing, around the 1970s. So the first strategy for individual investors came about in the early 70s. Jack Bogle at Vanguard basically created the first index fund, which replicated the S&P 500. There were other individuals doing that for institutional investors as well. But the idea is to find an index, a commercial index like the S&P 500, and to replicate it, and then just to participate in the returns of that market. Now, just for historical context, the S&P 500 historically has a 10% annualized return. So on a compounding basis, that's a pretty exceptional return to participate in. So there's really no need to try to do something different other than to capture that market return. And it also addresses the cost issue, the diversification issue, which you want. You want to make sure that you are also not trading too much in your account. So passive investing or index investing was really revolutionary And investors are benefiting and have been benefiting from that ever since, especially with the way that costs have just come down so much to, again, all of our benefits. So that's where you've seen quite a bit of growth in that space over the last several decades, particularly the last 10 plus years post financial crisis, where a lot of investors, learned some hard lessons. And then beyond that, in the 80s and 90s, there were a lot of other academic innovations when it came to investing, factor investing or smart beta or various terms for this. But essentially what this research has provided is that beyond stocks and bonds, because obviously the research shows that stocks historically outperform bonds, and then bonds historically outperform cash. But beyond those areas, within stocks, there are many areas within that have higher expected returns. An example of that would be small cap securities. So smaller stocks actually have higher expected returns than larger companies, right? That's one pretty obvious example. And why is that? Because again, you're taking on a certain level of risk. So as an investor, you should be compensated more for that. So, that's something that I think a lot of investors are starting to pay attention, that are a little bit more sophisticated. Not necessary for all investors, but how you go about factor investing is important as well, because the concepts I mentioned earlier, keeping costs low, turnover low, and diversification are all key to also employing factor investing to, again, have successful outcomes. But I would implore you all to educate more on moving beyond these ideas of active investing, because that's really what still gets pushed out there quite a bit. And think about these ideas of passive investing, where, again, it does simplify things for you as well. Investing does not need to be complicated at all. It's highly accessible to individuals. So that could be something that you should explore more in your own asset allocation. So we've talked about what's been happening in the market, scary times, some key principles that can help form your investment philosophy, things within your control, the evolution of investing, right? So let's get into how you actually build a portfolio, which is actually probably the most straightforward area that I'll discuss today in our conversation. I'm again happy to answer questions if questions are coming in. If not, we can move right along. But these are the portfolio building blocks. Very straightforward. And where it starts is what you're trying to achieve for yourself, right? So what is the objective? So an example of an objective would be retirement, right? If you're a younger professional in your years of accumulating or earning high income, you obviously are maybe 20, 30 years or so away from retirement, hopefully sooner. So that would be an example of an objective. But many of you have children, you want to save for college, for example, maybe start a business, purchase a home. So whatever it is that your objectives are, that should be the first thing to determine how your asset allocation should be built out. So I'll use the example of retirement, for example. So if you're an investor that has a horizon of, let's say, 20 or 30 years until retirement, and you're saving diligently into your 401k and other investments to be able to maximize the growth in your portfolio, you want to think about an asset allocation or an allocation mix. What that essentially means is your mix of stocks versus bonds that aligns with that particular objective. So if you've got a long-term horizon, essentially you can take on more risk and more stock exposure. I get this question all the time. So great, I should have more stocks versus bonds, but how much? What's the percentage of stocks and bonds that I should have, right? And that's a very good question. There's a lot of rules of thumb, if you will, that are out there. A very simple one, just as a tip for everyone here, if you have no idea of where to even start when it comes to your asset allocation, you can apply something like the 110 rule. So essentially what you do is you take the number 110 and you subtract it by your age. And whatever you end up with is the percentage of stocks that you should be in. So for example, if you're 30 years old, take 110 minus 30, that's 80. So you should be about 80% stock, 20% bond. Very high level. Obviously, you want to make sure that it's applicable to your particular set of circumstances. And again, this is the idea that this is for long-term investing. But that's a good way to start in thinking about what that allocation mix is. And why that's important is because going back to these concepts of asset allocation, that's going to be the biggest driver of your investment experience, your mix of stocks and bonds. So more stocks to less bonds, more volatility, but then higher expected returns. That's number two, is fundamental to that. And number three really is less important, but still relevant, as I mentioned, when it comes to things within your control, fees and diversification and turnover, for example. you want to get into funds that are low cost, highly diversified, and don't have a lot of turnover. So index funds are an example of that. So that's something where you want to then get into as you build your asset allocation. So, what funds should you even be buying, right? You should be, let's say 80-20, but what does that even mean, right? So going back to the exposure and the opportunity set of stocks and bonds, the US makes up about 50% or so of the stock market wealth or global market capitalization. So basically the wealth of all stocks. And then somewhere around 30 to 35% is the percentage of global market capitalization for international developed stock markets, which is about 20 or so countries. And emerging markets make up the remainder, right? Anywhere from 10 to 12%. So one simple approach is to just capture that exposure based on those percentages. So if you're a 100% stock investor, you would be 55% or so in the US, about 35% in international developed, and again, the remainder could be in emerging markets. So that's sort of a simple way to do that. And if you're investing in these broadly diversified funds, there's going to be funds, hopefully in a 401k, for example, that capture all these areas. Another thing that you can do is invest in what's called a target date fund. These are essentially funds within funds that automatically have all of this exposure for you and automatically adjust over time as you get closer to an objective such as retirement. So those are some, I think, helpful ways to think about your asset allocation. And that's pretty much it. 1, 2, and 3 are probably all you need to do. Beyond that, there are other areas I mentioned briefly. Item 4, home bias is essentially how much U.S. exposure, if you're a U.S. investor and you live here, is, okay, let's say 55% is what makes the U.S. stock market. Should I have more than 55%? That's the home bias. And that's perfectly reasonable to have maybe another 5-10% because you're in the U.S., you're consuming U.S. goods in U.S. dollars, and you obviously earn income and are investing in U.S. dollars. So it's perfectly reasonable to have a little bit more exposure to the U.S., for example, than the other international and emerging markets. So all you do is just kind of adjust your proportions accordingly. Talked about factor investing. If you wanted to employ something like that, that's certainly something that you can also add in as a flavor into your asset allocation. Core versus component, this is just picking a number of funds to build your asset allocation, or again, picking just 1 or 2 funds to build that out. So I like to just use things in a very simple fashion. If I can use a 1 fund solution, I'll do that where I can, just to keep things simple. And then getting into the asset class selection, that's, do you want to add real estate, or if you already own a home, that goes into your overall portfolio, for example. And then asset location. So this just gets into the tax question. Some securities within stocks and bonds are more tax efficient than others. So bonds pay out income more frequently, so they tend to be a little bit tax inefficient. So oftentimes the belief is that you should have bonds in your retirement accounts or in those tax deferred accounts versus your taxable accounts. Again, that's just a preference. If you're in retirement accounts, you probably are taking on more risk. So again, these are just things that other concepts that you can add as flavors into items 1, 2, and 3, but 1, 2, and 3 are the important building blocks. ESG, environmental social governance. So this has gotten a lot of traction over the last several years, rightfully so, and I'm pretty excited about this, but a lot of investors are now, again, speaking with their dollars, not just as consumers, but investors, and demanding that there be certain considerations in their asset allocation as it relates to environmental, social, and governance metrics, which is great. And there are a lot of funds that are being created as a result of that. So as that demand increases, investors now have the ability to have these things screened out of their portfolio. Let's just say fossil fuel stocks, for example. So there's more and more of a proliferation of those strategies for investors to choose from if that is your desire. And the great thing about that is that less and less are investors having to worry about giving up returns for excluding certain securities in their asset allocation. So as these strategies get better and screen better, they're just going to improve what investors want in their asset allocation, and again, therefore improve the investment outcomes. So I'll pause there again. Talked about quite a few concepts. The portfolio building blocks is essentially the meat of this conversation. as it relates to your situation and how to build a portfolio. I have a number of other concepts that I can cover, but I can pause there and maybe we can wrap with a couple of other slides. So I can bring this up. And again, if questions are coming in, I'm happy to answer those. If not, I'll keep rolling here. But just to summarize this conversation, some takeaways for you that hopefully you found a lot of this information helpful. Some takeaways in terms of some of the do's. Going back to these concepts and principles, control what you can control, right? You can control fees, the tax efficiency of your portfolio, how well diversified you are, and how much you're trading your portfolio. So focus on the things that you can control. The economy and the market are things well out of your control, but understand that over the long term, you're likely to benefit from that, as we've seen historical market returns. Even if in a given day, month, year, that's not the case, over time, the expectation is that you'll benefit from that, and compounding returns will improve those outcomes for you. So control what you can control. And then getting into those investment principles is picking that investment philosophy. So I implore you to do your research. You don't have to go too crazy in determining what all that is, but certainly have some sound principles that you can stick with regardless of what's happening in the market. You don't want news headlines. You don't want what your neighbor's doing. You don't want what's happening in the economy to drive your asset allocation. It should be driven by you, going back to the portfolio building blocks. What is it that you're trying to achieve? Set it up, automate as much as possible, plow into that and save as much as you can, and then you'll have good outcomes going forward. Let's see if we have questions. Okay, no questions. Okay, great. So I'll just keep going here. The idea of those that are saving and accumulating over time, that's really the biggest benefit that you have. Surprisingly, more than market returns is the ability to actually save. So if very simply, if I have $10,000 in an investment account and the market goes down by 50%, now I have 5,000 and it doesn't recover until, a few years down the road, but I'm saving diligently and I save an additional 5,000 into that account. Just by me saving into the account, 5,000, I basically have made up my losses, if you will, right? And then that again has the ability to compound over time. So that's why I emphasize save and invest, and then not same, but save and invest some more when you can. I mean, that is huge, especially if you've got a high income or you're earning an income where you have the ability to save. And if you don't, then work backwards and determine how you can adjust your budget to save as much as you can to be able to have the ability to save into these accounts to take advantage of the ability of compounding in your portfolios. Keep it simple. There's no need to overcomplicate this. I think there's a perception that some of this can be complicated, especially when you are seeing the headlines and hearing a lot of talking heads. Just be careful. A lot of people are out there selling things, right? So they may be selling a strategy. They may be selling ad space. Everyone's selling something. So consider the source when it comes to these things that you're being exposed to, and don't stay grounded in your philosophy, and don't let that drive your investment decisions, because it does not need to be complicated at all. And for those that are interested in actually hiring an advisor or already work with an advisor, my advice is to hire a fee-only fiduciary advisor that is not investments focused. So that sounds a little counterintuitive given that this conversation has been about investments, but it's been my experience that a lot of advisors are rooted in focusing on investments, right? So those advisors that I think are the best at what they do understand that there are many other areas that are a priority to you, right? Saving for your kids, saving for the long term, helping you achieve important financial goals like home purchases and other things, and making sure everything else is in place, whether it's insurances, work benefits, maybe you're starting your own business, advising around taxes, estate planning, etc. So an advisor that has the ability and the knowledge around all of these areas and that is not solely focused on investments is what I'm referring to. Clearly, if they're focusing on those areas, it's my understanding and my belief that they've done all of the research necessary and they've concluded that the investments, while important, should not be the priority and the focus, and they've kept that part fairly simple and hopefully around the areas that I've addressed today. Some don'ts, you probably guess, don't watch financial news or follow the market every day. It's just not going to be good for you. Whether it's mentally, emotionally, probably physically, it's not a sport. Um, regardless of what you may be seeing happening, be patient, be diligent, and you'll have good outcomes down the road. Don't try to pick winning stocks or time the market. Some people like doing that as a hobby. Just make sure you've got the proper plan in place, the long-term plan. If you want to go do that for fun, great, but don't let that drive your overall decisions when it comes to your total wealth accumulation plan. Don't lose patience. Again, be diligent. Have a plan, stick to it, save diligently. Know that these returns will come. They don't show up right away, but over time, as you build this portfolio, before you know it, these compound returns, boom, and your portfolio takes off. It's just the way that it works. So don't lose patience if you're just not really seeing a whole lot of growth. It'll come if you stick with it. And it's not supposed to feel like gambling. My belief is if you stick to this investment philosophy that I've talked about, and you do this over the long term and you're diligent, it's actually the opposite of gambling. The longer you do it, the more likely that you're going to be successful versus gambling, where you're likely to lose money the longer you do it. So it's not supposed to be like gambling. And this will feel better and you'll feel more confident and empowered about it if you follow these principles or learn to educate yourself around these principles and make these good investment decisions. Finally, I'll just wrap with some resources. I love being a resource. These are some books, blogs, and other resources that I've read myself, that I follow. If you want to take a screenshot of this, but these people speak a lot of common sense around a lot of the concepts that I've referred to today, that hopefully you'll get out of a lot from them, following them. I've also published a couple of articles below. If you just Google those are probably on our company website. Speak to a lot of the concepts that I've referenced today. So with that, if there aren't any other questions, we can wrap, but I'll let Dana determine that from there. I'll leave this up for everyone. But essentially that concludes our conversation today. I hope you all got something out of it. And again, my email is up there. Happy to be a resource, at the very least, just to clarify any of the concepts addressed here or to answer any questions. So thank you for your time.
Absolutely. And thank you so much for coming on, Jorge. This has been great. I hope everyone has got as much knowledge or kind of a relearning spot as well. I mean, sometimes it's good, even if you feel like you kind of have the groundwork, to just kind of get a refresher of what you need to do, especially in the time that Jorge is talking about, going through COVID and really seeing the ups and downs of the market in a way where we really haven't seen before. And kind of getting used to what that might look like if it ever does happen again. So thanks again for coming on, and just really appreciate all the education and the tips that you gave today.
Yes, thank you for having me. Hopefully everyone is doing well, staying healthy, and hopefully we'll all get to enjoy our lives with some normalcy in the days ahead.
I know. Hopefully we'll get back to that place sooner than later.
We will eventually. Just
exactly.
Probably not right away, but we'll get there.
Exactly. We will definitely get there. So thanks again for tuning in to the episode of the Represented series, and please continue to stay in touch with us at chipprofessionals.com, where you'll also find Jorge, who is one of our chip professionals and also working for AdvicePeriod. So feel free to stay in touch, and we'll see you soon.
Thank you.